Hi folks, welcome to this video on calculating basic and diluted earnings per share when there are actual conversions. In this question we have two convertible securities, bonds and preferred shares. You'll notice that the preferred shares were never converted, but the bonds were. The bonds were converted in the 11th month at December 1st. So because we had an actual conversion, we're going to have to calculate how that would have affected our basic EPS calculation, because one thing we know for sure is when there are actual conversions of convertible securities, there's definitely going to be an impact in our WACs. So in our case, because we've got bonds, it's definitely going to have an effect on our WACs. So let's see what that impact will be. Well, in the numerator, what will the impact be? The question told you that to calculate your basic earnings per share, you're starting with net income or net earnings of $366,000. We know that basic EPS is what? Net income less preferred share dividends, and we would divide that by our WACs, right? So we've got our income. We know what the preferred shares were that were paid during the year, declared and paid during the year, and they told us it's 50 cents a share, and we had 30,000 shares outstanding. So there were no conversions of the preferred shares, so we deduct the full dividend, and we'd have $351,000 available to common. Now, because we actually converted the bonds, that means that we're going to have more common shares outstanding. So now, what would the impact have been on our WACs for our basic EPS? Well, the question told us that we had 150,000 common shares outstanding from the beginning of the year all the way to July the 1st. So we would have had that 150,000 shares outstanding for 6 of 12 months. On July the 1st, we issued an additional 300,000 shares, which now gives us a total of 450,000 shares. And they were outstanding until December 1st. So from July the 1st to December the 1st, that's a full 5 months. Now, it was on December the 1st that they converted all of the bonds, which were 600,000 in bonds, to common shares. So what difference would that make in our WACs? You can see here I've calculated the total number of shares outstanding after the conversion of 516,000. But let's see how I did that. Well, the question said that we had 600,000 in bonds, and it says that each $1,000 bond, so dividing by 1,000 to find out we have 600 bonds, each bond which is worth $1,000, and there's 600 bonds. Each of the 600 bonds was converted into 110 common shares. So that would give us what? That would give us an extra 66,000 shares. So those 66,000 shares, so this bracket distills down to 66,000. If you add that to your 450,000 that you had outstanding at December 1st before you converted the bonds, then that means that you would have a total of 516,000 common shares outstanding at December the 1st. Multiply it by the number of months they're outstanding, which is your weight for your WACs, and that would give you 43,000. So if we multiply all these lines across to get the numbers on the right, and then we add them all up, you're going to see we're going to get a weighted average common shares for the year of 305,500. So if we take our 351,000, which is our numerator, net income less preferred share dividends, divided by our WACs, which is here, we're going to get $1.15 per share. So now what we want to do is we want to compare all of the convertible securities, their EPS impact. We want to compare that to the basic to see whether or not these securities are in fact dilutive. So let's do step 2. Here in step 2, I'm focusing first on the preferred shares, and you'll remember that none of them were converted. So we could have avoided paying out a full $15,000 in dividends and have that available to common. Now, how many shares would have been issued if we had converted the preferred shares at the earliest opportunity during the current year? And that would have been January 1st, because the preferred shares were outstanding all year. Well, the question told us that the preferreds were convertible 2 for 1, which means for every preferred you get 2 common. So there would have been 60,000 shares outstanding. common shares outstanding. So 15,000, that's your dollar figure, divided by your common shares, that would give you 25 cents a share, which is less than $1.15, so they're dilutive. Now let's have a look at the bond. And with the bond, what we have is we have an interest expense, which they gave us in the question. You'll notice in the question when they discuss the statement of comprehensive income, they say that net earnings after $47,250 of interest expense to December 1st on the convertible bonds. So they actually calculated for you the interest expense up to the date of conversion for the year. So you didn't have to calculate it. That's $47,250. Now we would have avoided booking that interest, which would have done what? It would have increased any earnings available to our common shareholders, because we would have had $47,250 in interest expense that we wouldn't have booked, which would have increased our net income before tax by that much, which meant more net income would be available to our common shareholders for distribution. And what would that have meant? Don't forget, our tax rate is 30%, so we want to calculate the impact of the interest expense that could have been avoided on an after-tax basis. So that means that we could have had an additional $33,075 available for the common shareholders. But now, how many more shares would we have issued if we had converted that $600,000 in bonds 11 months earlier? Well, we've already calculated that number to some extent. All right, we said for each $1,000 bond, it was convertible into 110 shares. So we had 600 bonds, each convertible to 110 shares. We calculated this number to be 66,000 when we were calculating our WACs for our basic EPS. But now we have to weight it. Why? Because we said, what if those bonds had been converted 11 months earlier? How many more shares would we have out there on a weighted basis? That would have been 60,500. So 33,075 divided by 60,500 would give us 55 cents a share. That too is less than $1.15, so they're both dilutive and both in the cascade. So now, which one goes first in the cascade? The one that goes first is the one with the smallest EPS impact, right? So that one is your preferred shares. So if we put our preferred shares into the cascade, so we're going to start in the cascade with our earnings available to common and our WACs from our basic calculation, which gave us $1.15. And remember, our whole point here is to make sure that at every step that we enter new securities in, that the EPS is getting smaller. So we're going to subtotal, right? So we're going to subtotal every time we add a new security. In this case, we're putting the preferred shares first because their EPS impact is the smallest. So that means we would have increased our earnings available to common by 15,000, and we would have also increased the number of shares issued, okay, if they had been issued earlier, okay, which is 12 months earlier, we would have increased our common shares outstanding for 60,000. So if we do a subtotal, what would our cumulative EPS be on a diluted basis? We'd have 366 divided by 365.5. That would give us about $1 a share. So you can see it's less than $1.15. So now we have a diluted position of $1 at this point. But we haven't finished. We have to now add in the bonds. So now if we add in the bonds, what do we have? We see here that we would have avoided interest that we calculated up here in step 2 of $33,075 if we had converted the bonds 11 months earlier. We would have avoided expensing all of that interest, which means we would have had an extra $33,075 available to our common shareholders. And if we had converted those bonds earlier, we calculated up here that on a weighted basis, if we had 11 months earlier converted those bonds to shares, we would have had an additional 60,500 shares outstanding on a weighted basis. So now if we add this to our subtotal and this number here to our subtotal, we're going to get earnings available to common, $399,075. our weighted average common shares would have been 426,000 weighted average common shares. So if we divide 399,075 divided by 426,000, we would have 94 cents a share. So we would show on the face of our income statement or statement of comprehensive income, basic EPS of $1.15, and again our diluted EPS of 94 cents per common share. So this concludes our video on actual conversions when we have convertible bonds that were converted and convertible preferred shares which were not converted. I hope you found the video helpful.